T-bills, short for Treasury bills, are ultra short-term Treasury bonds backed by the full faith and credit of the US government. In this video, I'll explain what exactly T-bills are, how they work, and why you might want to buy them. So what are T-bills? T-bills are just ultra short-term bonds from the US government. These short bonds with maturities of less than a year are called bills. The US Treasury issues T-bills to raise cash to fund the federal government's spending. Since they're issued by the Treasury, naturally we call them Treasury bills, or T-bills for short. Because they're backed by the full faith and credit of the US government, T-bills possess no liquidity risk, credit risk, or default risk inherent of corporate bonds. As such, T-bills are quite literally the risk-free asset, as they're called, and they pay what we refer to as the risk-free rate to which other assets are compared. These special, seemingly boring bonds are considered a cash equivalent. When we say part of the portfolio is in cash, we usually mean T-bills, not plain dollar bills losing to inflation. So why would anyone buy T-bills? Longer Treasury notes and Treasury bonds typically pay more than Treasury bills because they have more interest rate risk. But of course, a 15-year Treasury bond would not be appropriate for your planned purchase of a new car 1 year from now, whereas a 1-year T-bill would be ideal. The short maturities of T-bills also make them useful for retirees who regularly need cash from their portfolio to cover expenses in retirement. At this point, you might be thinking this all automatically means negligible returns from Treasury bills, but you'd be wrong. Their annualized historical return over the last century was 3.32%. The average rate of inflation over that period was 3.02%, which means a real return or return adjusted for inflation of 0.3%. T-bills have been particularly attractive recently with interest rates being relatively high. At the time of this video, T-bills are paying around 5%. T-bills are usually going to be paying slightly more than a plain savings account or money market fund. How do T-bills work? T-bills are sold at a discount and don't pay a coupon like most bonds, so they simply return their face value at maturity. The difference between your purchase price and that face value is your interest. For example, a T-bill with a face value of $1,000 and an implied rate of 5% is sold at a discount of $952, which we call its present value, which is simply $1,000 divided by 1.05. The effective interest from T-bills is federally taxable as income, but is exempt from state and local taxes. This makes T-bills particularly attractive for those in states with high income tax rates. Because they're able to be rolled quickly, T-bills are also a decent inflation hedge. T-bills essentially kept pace with inflation during the double-digit inflation of the 1970s in the US. T-bills are a great place to park excess cash to be used for near-future liabilities so that you don't lose that purchasing power to inflation. This might sound crazy, but there have also been extended periods where T-bills outperformed the stock market. The 15 years from 1929 to 1943, the 17 years from 1966 to 1982, and the 13 years from 2000 to 2012. At this point, you're probably curious about how to buy T-bills. You can buy T-bills directly from the US Treasury via their website treasurydirect.gov, indirectly through most major brokerages like Fidelity or Schwab, or through ETFs or exchange-traded funds that hold and roll T-bills for you. I'd argue that last one is probably the easiest logistically. Click here to watch my video covering the best ETFs with which to buy T-bills. Do you own any T-bills or are you planning on buying any? Let me know in the comments.